So the reckoning for the US bubble is coming. In fact, we are seeing real problems build up in the economy. We are seeing two issues that are going to give the tech bubble a real wake-up call. Now, a few days back, we saw the Fed cut rates by 25 business points. But as we have said many times, it doesn't really matter for long-term yields. The borrowing cost in the real economy is affected by supply and demand. In fact, by cutting rates on a short end, Trump told the world that spending is out of control and that the dollar will be debased even further. As a result, investors, they're going to demand a higher return to hold U.S. paper. Now, the 30-year yield has hit the highest level since early September. This just shows a loss of fiscal trust, rising inflation, and a lack of faith in the dollar. Yields have hit 4.85%, 85%. Now, when the 30 years suddenly spikes up, it forces a repricing of all other bonds. If long-term confidence collapses, shorter-term confidence also gets rocked. The inflation concerns are real. Now, the real crisis comes when we look at the 10-year yield. This is super critical for the real economy. Doesn't just affect borrowing for the data centers, but for Main Street as well. Now, the 10-year is now moving towards 4.2%, 2% breaking out of consolidation since September. This boring rate controls everything. Now, when the 10-year rises, everything from mortgage rates to companies issuing debt gets hammered. It's particularly important to realize how much upwards pressure there is on yields. Today, government spending is immense, and even more crazy promises are coming from the administration. Now, every time Bessent or Trump promises anything, understand that it comes from deficit spending. They have to borrow the money to existence, which just keeps yields even higher. Now, the government itself is the biggest competitor for money, and it just drains the entire economy of capital. It's just one big spending spree that pushes this bubble closer and closer towards the edge. Now, Bessent has confirmed that working Americans will soon get large refunds. They will get a tariff dividend of up to $2,000 per household, not per person, but per household. But this will still cause hundreds of billions pouted onto the national debt. And even if all this money is borrowed through short-term bonds, it will still cause an inflation problem. Now, when inflation rises, everyone gets spooked out. Domestic investors, they revolt. Foreign investors, they get fearful. The long term looks uncertain as suddenly longer-term rates, they get repriced up. Now, Bessent is still very upbeat about U.S. bonds. Notice the dissonance here. He is hyper-focused on keeping government spending costs down, but not for Main Street. The bond market had its best year since 2020. And if I have anything to say about it, as your nation's top bond salesman, bonds will have another strong year in 2026 as we fight to bring Treasury borrowing costs down. Notice how the narrative is starting to break down for the wider economy. Yes, Washington can borrow at lower short-term rates, but real-world companies can't. And even the big tech companies are trapped in a world of escalating rates. And that's why stocks were crashing yesterday. The capital squeeze is just getting worse. The Nasdaq is down by almost 2%, while the S&P fell by 1.1%. This is as the Fed is cutting rates into strong GDP numbers, but stocks are not flying up. The reverse is happening here. AI semiconductor stocks are getting pummeled down. At the same time, power generation stocks are also getting hit, and it should be obvious why. To fight the chip and AI war with China, a lot more investment is needed. But how is this sustainable when bond yields are rebounding higher? Companies leave in the real world, and they need to justify all this spending sooner or later. Now, this AI war is not being fought in a vacuum. China's a big competitor on the other side of the world, and they are using their own financial engineering to put a squeeze on the United States. There is a big difference, though. China's rate cards are more effective than the U.S. because their inflation is almost non-existent. In fact, they are flirting with deflation. Now, China's bond yields are expected to drop to record low in 2026. Beijing is going to fire on all cylinders, including making their own red cards to fight back, and they can sustain this for a very, very long time. The U.S. is in a bad position. Decades of financial engineering has backfired, and the economy is sandwiched. There's massive government borrowing, sticky inflation, and a national debt crisis. And no matter what decision Trump takes, one leg of this three-legged stool will break he would have to choose between higher inflation or the bond market breaking. Now, according to SocGen, Chinese 10-year yields could fall to 1.5% or even below. That is the benchmark borrowing rate that also affects how much Chinese companies can borrow. Now, the PBOC is going to cut rates by 20 basis points because they simply can. There's zero inflation worries in China, so they can use financial engineering themselves without much blowback. Next year, borrowing costs for Chinese companies could get over 20% cheaper is a signal by the central government to borrow more and ramp up AI spending. Spend more on chips to fight against the U.S. This is a terrifying backdrop American companies are facing. As we said, things are not operating in a vacuum. As China borrows more capital from the world, money is also denied to U.S. hyperscalers, Meta, Google, NVIDIA, OpenAI, and of course, Oracle. They in deep trouble. The funding squeeze is serious, and they will need to cough up the money somehow. Now, HSBC projects OpenAI will face nearly $500 billion in cumulative operating losses by 2030. That's $500 billion worth of pain. And why is this disaster happening? Because of massive deals with the hyperscalers. OpenAI has committed to nearly $800 billion in data center cost over the next 5 years. It's a far cry from Sam Altman's $20 billion in revenue this year. Not profit, just revenue. So you can see how crazy things are getting. Pie-in-the-sky dreams, they're now clashing with reality. The bond market is starting to teach Trump's AI race a very tough lesson. And just like the housing crisis, there's always a black sheep in a family, right? There's always a company willing to push things to the limit. Back in '08, it was Lehman Brothers, the outlier that could port the entire bubble and send a house of cards crashing down. Now, a big reason for the NASDAQ crash yesterday was because of Oracle and a daily rumor that they are facing a data center crisis. Now, of course, they denied it, but the impact is very material and the damage has been done. Oracle stock fell by an incredible 7% in a single session. Reports were circulating that their data centers for OpenAI has been delayed by a year from 2027 to 2028. Obviously, this isn't good news. There's either labor or hardware shortages, or the infrastructure and energy grid isn't geared up for such an expansion. Delaying it by a year is horrific because the debt doesn't magically go away. You'll still need to pay interest on it, and you won't be earning revenue during the same period. And Oracle desperately needs revenue to reduce their risk. They have nearly $100 billion in debt while their earnings are barely $30 billion. There's a big gap here that needs to be resolved as soon as possible. But the higher rates go, the higher the 10-year continues to gap up, the worse things will get. Oracle's future borrowing cost could heat up. But if revenue doesn't fly to the moon, this is not going to end well. When it comes to gauging sentiment, nothing is better than asking investors themselves. It's all about returns and ensuring they don't get screwed should the AI bubble implode. Now, credit default swaps, or CDS, is an insurance bet traders make on corporate debt. If the company defaults, the traders earn money. It's casino betting, but it tells you how afraid people are of the AI bubble. Now, compared to investment-grade CDS, Oracle's default swaps have sought to the moon, almost 120 basis points higher. Today, you need to pay at least $140 to insure $10,000 worth of Oracle's debt. And that lowers your return by 1.4%. And if that's the case, why even buy debt from all these hyperscalers? You might as well buy a treasury bond that yields 4% without any risk of default. This just pushes up the cost of borrowing for everyone. Investors will demand higher return even from all these AI hyperscalers, and that's why the fat rate cards are superfluous. They do not affect the real economy. It's all about supply and demand. There's a lot of debt supply, but demand is starting to dry up. People understand the physical realities of building all these data centers. Costs are going up because of tariffs. Steel, copper, and aluminum are much more expensive, but power costs are also escalating. Just building the power grid alone is going to cost a lot of money. This is the amount of data center power demand versus spare grid capacity in the United States across many grid operators. There is a serious gap in power. In some areas, there is a deficit of almost 3 to 4 times spare capacity. And to correct this gap, hundreds of billions of dollars will be needed. This is separate from the money needed to build data centers themselves and to staff them full of AI chips. The AI race is becoming a big albatross that's draining money from everything else. Now, the issue is the amount of buildup that's necessary, even in power generation capacity. The U.S. has to catch up with China, and if they don't give it enough time, China would win the AI race. China today has over 3.3 terawatt hours of power generation. It's a mixture of fossil fuels and renewable energy, while power is still power. The U.S., however, is generating less than 1.3 terawatt hours, and this drives electricity prices up for everyone in the U.S. Domestic household power costs more. Factories have to pay more, and of course, data centers as well. Now, Chinese data centers can secure power for as little as 3 cents a kilowatt hour. U.S. data centers might have to pay triple the cost, up to 9 cents in some cases. There's only one way to close the gap, and that is to borrow even more money to build out the grid. We are facing a dangerous moment in this AI bubble. Is there a way out of this mess? Well, what the Federal Reserve just did 3 days back gives us the playbook here. A clear path is for the Fed to come in and start buying up U.S. government bonds. And this will absolutely nuke the value of the dollar and the bonds, but it's necessary to prevent a bubble implosion. Now, what does this mean? If you're a U.S. bondholder, chances are you will get inflated away. Your holdings will probably get debased in real terms. The digits won't change. You'll still get your interest payments, you'll get your coupons, and you'll get your capital back. But when it comes to buying real stuff, food, gas, real estate, gold, and silver, you'll be paying much more for them. And this is how precarious things are getting. The more the AI stocks collapse, the more Oracle begins to crack, the closer we are to the end game. And that is print, baby, print all the money needed. But let me know what you think, which is more likely, allowing the AI bubble to implode or for the Federal Reserve to step in and print the money. Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through this crazy times.